let's bring in our panel. We got to talk about these cloud stocks, many of which are down about 10% off the highs. Dan Romanoff is with us, equity analyst, Morningstar, and Julie Bhusal, Sharma, equity analyst, also at Morningstar. Thank you both for being with us. So let's have a good discussion here. Julie, I'll start with you. So I was looking, for example, at the cloud November ETF that hit a high in November. And then over the last 1 month or so, it's down about 11%. Tell me about your thoughts about the moves that we're seeing and where there could be opportunity, or is this to be expected?
Yeah, so I think a lot of this is fears in just the new variant accumulating, as well as fears in higher rates, which definitely slice those distant cash flows, which tech valuations weigh even more heavily upon just because of their growth rates. So, we've seen a rebound today somewhat in tech stocks, but we think there's still some nice opportunity there as we haven't seen that rebound fully compensate for some of the sell-off in some of these names. So one particular name that I like is SAP right now, which I think is trading pretty attractively right now. It's been down about 10% this past month, and we have it at a fair value estimate of 131 euro per share, which gives it about 9% upside. But even though our qualitative thesis on SAP really isn't as high as some of its competitors like Workday, which we think is super high quality, we think the market is taking that lower quality for SAP and actually over penalizing it, which is making it an attractive buy right now.
Okay, thank you for that, Julie. We'll continue to watch SAP. And Dan, I know you still think that there are some software stocks here in this cloud group that really are still very attractive. And you have some names that are more here at home and some of the high quality big names we know. Tell me a little bit about those, Dan, and why you think there could be some opportunities.
Sure, and thanks for having me. And I love talking about cloud stocks. So, we're talking about Microsoft, ServiceNow, Salesforce. These are some of the, the most blue chip names in software. The growth potential of these stocks is tremendous. You really don't see this kind of growth in any other industry. From a free cash flow margin perspective, they are also at the top of the heap. So they're just really attractive. The balance sheets are rock solid with very little debt. So it's you can't really throw a dart, but there's a lot of good names to pick from. And in the last month or so, as you were pointing out, 6 weeks, maybe even now, there's been a tremendous pressure on the group. And really, for the first time, I think, in the last year and a half, you have an opportunity to pick off some great names at pretty reasonable valuations, like a Salesforce or like a ServiceNow or even Microsoft. So, I think there's lots to be excited about.
Okay, so that explains some of those good names that you like, the high quality names. I do want you to talk in a moment about Zoom and DocuSign and some of the names that people may have loved but have been out of love lately. Julie, as we take a look, and there's obviously concerns about everything from new variants for COVID and work from home, work from anywhere. Tell me, expand it out, because I see here you say recommend selling Oracle shares, for example. What are some of the big trends that you're seeing? So if an investor is thinking in their mind, they can sort of go back to what you were saying here.
Yeah, I think a lot of it is based on fundamentals. So even though earlier to you, Nicole, I recommended a buy for SAP, I think there's still a handful of cloud software stocks that are still overvalued. And so, for instance, if you were an investor on Friday, maybe beating yourself up about not selling out of some stocks, before the sell-off, we think this is kind of your second chance with this rebound. And why we think there's a handful of stocks that are still overvalued is more going back to fundamentals. So with Oracle specifically, we think it's trading at a 40% premium based on our $65 fair value estimate. And we think, fundamentals wise, that's really in relation to the market not factoring in the full Amazon threat. So we think it's, we have to look at it on a company specific basis there.
Right, and hey, it's great if you could take a little money off the table, or and you've made some money. I mean, there's absolutely nothing wrong with that. I mean, fundamentals and growth projections consistently change. Dan, final thoughts here, because I know you had Zoom and DocuSign. I mean, DocuSign, forget it, got clobbered. But I don't know if anybody wants to comment on cybersecurity. I'm almost out of time. But anyway, Dan, final thoughts here.
Yeah, just some of those high flyers you mentioned, those work from home trades, those are basically round tripped. And they're kind of where they were at about 2 years ago, like before the pandemic started. And meanwhile, fundamentals are actually pretty good for these names, despite like DocuSign's quarter. So if you're Zoom, for example, there's definitely an acceleration in adoption of like software-based phones. And that's real. And that's a trend that will persist now for many years to come. So I think there's opportunity to be had in some of those names as well, even if they has been totally decimated lately.
A Morningstar panel with 2 stars. Thank you both. I enjoyed our conversation very much. It was nice to chat with you both. Thank you for your insight. We really appreciate it. Dan Romanoff and Julie Bhusal Sharma of Morningstar. Thank you both very, very much. A nice look there at the cloud stock.